What is the one tax that almost nobody sees coming until it's already been deducted from their Social Security check? It's called IRMAA, and if you aren't careful, it is going to take a giant bite out of your retirement income. I want you to listen to me, and I want you to listen closely. Many of you have worked your entire lives, you've saved, you've done everything right, and now you're entering your golden years thinking your Medicare costs are fixed. You think, okay, I know what the Part B premium is, I can budget for that. But then, you get a letter in the mail from the Social Security Administration telling you that you owe more. Much more. And you're sitting there wondering, how can they do this to me? IRMAA stands for Income-Related Monthly Adjustment Amount. It is not a separate plan, it is a surcharge. It is an extra fee added to your Medicare Part B and Part D premiums. And here is the fear, it is a cliff penalty. If you go just $1 over the income threshold, one single dollar, you are pushed into the next bracket, and your premiums could spike by hundreds of dollars a month. For a couple, we are talking about thousands of dollars a year in extra costs that provide you with zero additional medical benefits. You're paying more for the exact same coverage. Now, how does the government decide if you're wealthy enough to pay this? They use a 2-year look-back period. That means your premiums for right now, in 2026, are being determined by the tax return you filed for 2024. This is where the trap is set. Many of you in 2024 were still working, or maybe you sold a home, or you did a big Roth conversion to be smart about your future taxes. You had a one-time pop in income. The government looks at that 2024 return and says, aha. You're a high earner, even if today, in 2026, you are retired and living on a fixed budget. Let's look at the numbers for 2026, because they have changed. If you are filing a single return and your modified adjusted gross income, that's your AGI plus any tax-exempt interest, don't forget those muni bonds, if that number was over $109,000, you are in the IRMAA zone. For married couples filing jointly, that threshold is $218,000. If you are just $1 over that $109,000 mark as an individual, your Part B premium doesn't stay at the standard $202.90. It jumps. It goes up by an extra $81.20 every single month. And it doesn't stop there. There are 5 tiers. If your income was over $500,000, you could be looking at a total Part B premium of nearly $690 a month. Per person. If you're a couple, you're writing a check for almost $1,400 a month just for Part B. That is a lot of money that should be staying in your pocket for your food, your travel, and your peace of mind. So, what is the problem here? The problem is that most people don't realize that certain financial moves trigger IRMAA. Selling a house and taking a big capital gain? That's an IRMAA trigger. Taking a large RMD from your traditional IRA? That's an IRMAA trigger. Even those tax-free municipal bonds that you think are so safe? Their interest gets added back in for the IRMAA calculation. The government is very good at finding your money, my friends. But I don't want you to be afraid, I want you to be prepared. There is a way to fight back. If your income has dropped since 2024 because of a life-changing event, you do not have to just sit there and take it. What is a life-changing event? It's retirement. It's the death of a spouse. It's a marriage or a divorce. It's the loss of income-producing property. If you retired in 2025 or early 2026, and your income is now much lower than it was on that 2024 tax return they're using, you need to file Form SSA-44. This is your get-out-of-jail-free card. You tell the Social Security Administration, hey, I'm not making that money anymore. I'm retired. Use my current income instead. If they approve it, those surcharges disappear. But they aren't going to do it for you. You have to be the master of your own financial destiny. You have to file the form. The actionable takeaway here is twofold. First, if you are about to retire, look at your income from 2 years ago. If it's high, get Form SSA-44 ready the moment you transition. Second, for those of you still a few years away from Medicare, you need to start managing your taxable income now. This is why I talk about Roth accounts so much. Withdrawals from a Roth IRA do not count toward your MAGI for IRMAA. If you can shift your wealth into tax-free buckets now, you are protecting yourself from higher Medicare premiums later. Retirement is supposed to be the time when you stop worrying about the man taking your money. But IRMAA is proof that the government has a long memory and a sharp reach. Don't let a 2-year-old tax return ruin your monthly budget today. Check your brackets, watch your one-time income spikes, and if your circumstances have changed, stand up for yourself and file that appeal. You worked for that money. Now, make sure that money works for you. With that said, thanks for watching and until next time.